The richest gold rush on Earth isn't happening in a mine. It's happening in climate-controlled warehouses where the lights never turn off and the machines never sleep. One company just reported year 2025 revenue of $130.5 billion, up 114% in a single year. That's not a tech story, that's a macro event. Nvidia reported year 2025 revenue of $130.5 billion, up 114% year-on-year. In the same fiscal year, net income hit $72.9 billion, up by about 145%. Profit expansion at that scale doesn't just move a stock, it redefines what one company can do to an entire market. If computer's the new oil, Nvidia just became the biggest oil-producing entity in the world. The engine driving those numbers? Data center. Nvidia's data center segment posted Q4 fiscal year 2025 revenue of $35.6 billion, up 93% year-on-year. For the full fiscal year, data center revenue rose 142% to a record $115.2 billion. This isn't a side hustle, it is the business. Nvidia's Q4 year 2025 total revenue came in at $39.3 billion, up 78% year-on-year with 82% profit growth, not just revenue growth. And the moment those numbers land, the entire market recalibrates. Earnings night isn't just a report, it's a referendum on the future. The question isn't, did they beat? It's, can they keep ramping fast enough to satisfy demand? The answer depends on one word: Blackwell. Nvidia said it successfully ramped up the massive scale production of Blackwell AI supercomputers. More importantly, it achieved billions of dollars in sales in Blackwell's first quarter. The next generation isn't coming, it's already here. And it's already monetizing. But scaling this fast comes with a cost, literal and operational. If supply is ramping, why are margins starting to dip? Nvidia's Q4 fiscal 2025 GAAP gross margin was 73%, down from 76% a year earlier. That's not a collapse, it's a clue. Scaling at this velocity means complexity, advanced packaging, liquid cooling, and logistics nightmares. Nvidia's Q4 operating expenses were about $4.5 billion, up 48% year-on-year. Nvidia is spending aggressively to stay ahead because in this race, falling behind means losing the cycle entirely. But here's the part Wall Street loves. The boom throws off cash, not just headlines. Nvidia reported net cash provided by operating activities of $64.089 billion for fiscal 2025. Free cash flow hit $60.724 billion, money that can be recycled into more capacity, more R&D, more dominance. Cash separates AI story from AI reality. But even cash machines live and die by one sentence: guidance. Nvidia guided Q1 fiscal 2026 revenue to $43 billion, plus or minus 2%. It also guided GAAP gross margin to 70.6%, plus or minus 50 basis points, effectively saying, we're still scaling, and it's still costly. Guidance is how the market prices the next chapter before it happens. One number can move billions. One miss can erase months of momentum. Finance has a brutal way of reminding you that not all assets are equal. Nvidia disclosed a 10-for-1 stock split effective June 7, 2024, an example of how perception and access reshape narratives around the same underlying business. Meanwhile, a US bankruptcy judge approved FTX's liquidation plan to repay customers using as much as $16.5 billion in recovered assets. Reuters reported FTX aimed to repay 98% of customers with accounts under $50,000 within 60 days after the plan's effective date. Approved is not the same as paid. Assets are not the same as cash. Retail loves simple stories. Stock split, AI boom, the future. Nvidia reported fiscal 2025 GAAP EPS of $2.94, up 147% year-on-year, rocket fuel for that narrative. But behind the hype, the business is still a set of concentrated dependencies. Buyers, infrastructure, CapEx cycles. And concentration is the hidden risk in every boom. Nvidia's fiscal 2025 total revenue was $130.5 billion. Full-year data center revenue was $115.2 billion. One segment is carrying the entire narrative. Meanwhile, Q4 gaming revenue was $2.5 billion, down 11% year-on-year. Not every segment rides the same wave. If the whole story hinges on data center CapEx, what makes that spending slow down and how fast could it hit results? The slowdown doesn't start with AI disappointment. It starts with something boring: power, cooling, construction timelines. Nvidia's Q4 data center revenue rose 16% quarter-on-quarter to $35.6 billion, still accelerating. And inventories hit $10.08 billion at the 26th of January 2025, up from $5.282 billion a year prior, consistent with a business staging more hardware. If the constraint shifts from chips to infrastructure, the bottleneck becomes electricity, cooling, and permits not Moore's law. Nvidia's fiscal 2025 operating income was $81.453 billion, up 147% year-on-year. Numbers that look less like tech and more like an industrial-scale profit engine. With Q1 fiscal 2026 revenue guided to $43 billion, Nvidia signals the surge may continue at least in the near term. But every boom eventually hits its own mirror test. Are we building capacity for real utility, or building capacity because everyone else is? Step back and the pattern looks familiar. A boom builds an ecosystem, then the ecosystem becomes the battlefield. Nvidia framed Blackwell demand around agentic AI and reasoning AI, new waves that require even more compute for training and inference. If that's true, the hunger for compute doesn't fade, it mutates. But the real cliffhanger is this: Nvidia's Q1 fiscal 2026 GAAP gross margin outlook of 76% suggests the next stage remains expensive and operationally intense. The story isn't AI wins or AI fails, it's whether the economics hold once the build-out becomes normal. Because once the world finishes buying the shovels, it starts asking what the shovels are actually for. If compute is the new oil, then we're not just watching a tech story, we're watching an energy story, a logistics story, and a finance story collide. And that collision is where fortunes get made and where they get stranded.